In this video, we are going to talk about top recession-proof dividend stocks to buy in 2021. So before starting this video, please like this video, and subscribe to our channel for the future updates. In retirement, the primary objectives are to preserve resources and generate a steady stream of profits. As a result, it's not shocking that conservative investors are concerned about the next recession and how it will affect their portfolios. Safe dividend-paying stocks may be a good option for retirees who want a steady stream of income that is unaffected by economic conditions or short-term stock price fluctuations. During the financial crisis, over 240 dividend-paying stocks in our database retained or raised their dividends last year, outperforming the S&P 500's 55% peak-to-trough drop by more than 20%. Here's a list of the top recession-proof dividend stocks to buy in 2021. Let's start. Number 10. Amgen. Analysts have been perplexed by Amgen's AMGN results. On the one hand, their top line has slowed as sales from their previous top drug, Enbrel, has slowed. However, sales of the drug are expected to reach $4.2 billion in 2018. Furthermore, Amgen anticipates maintaining exclusivity with Enbrel until 2029. Aimovig, a new migraine drug, was also launched, and the company is hoping that it will help boost the top line. Despite the concerns about their top line, Amgen's second quarter earnings were announced on July 26 and exceeded expectations. Amgen is also ranked as a consensus buy by analysts, with a 6.2% increase in stock price expected in 2018. The company also paid a $1.32 per share dividend, resulting in a dividend yield of 2.77%. Number 9. Ross Stores. Buyers run to value as the economy slows. Ross Stores, Rost, a discount clothing retailer, thrives in this setting. Although the company has already captured the budget-conscious shopper, it has also demonstrated tested success among more affluent customers when the economy slows. During the Great Recession of 2008, the company opened 66 new locations. In that time, it outperformed the S&P 500 by 56%, returning 17.6% to shareholders. Analysts are forecasting a 6.4% rise in year-over-year revenue ahead of the company's second quarter earnings announcement on August 16. Ross Stores has a consensus buy ranking, with stock prices expected to rise by 0.7%. During recessions, investors seek the relative safety of dividend stocks. Ross Stores has a current dividend yield of 1.04% and pays an annual dividend of 90 cents per share. Number 8. Costco. Costco, Cost, is demonstrating that steady growth is possible in a market that includes Amazon. Costco competes with other companies in this market for customers who find shopping in bulk appealing when the economy is healthy, and even more so when times are rough. These customers are firm believers in the model, and a trip to Costco can be a one-stop shop for them. Although some stores continue to struggle, same-store sales at Costco increased by nearly 10% in the first half of 2018. Despite the price hike, membership renewal rates, which account for the majority of their profit, have remained stable at around 90%. With their investments in e-commerce and home delivery, as well as new locations set to open, including a planned expansion into China, analysts expect Costco's net income to rise at a rate of just under 12%, 11.9%, every year over the next 5 years. Number 7. McDonald's. McDonald's, MCD, can be difficult to remember for certain customers. The golden arches have faded from view as the fast food behemoth has updated the look and feel of its locations to cope with new fast casual entrants. Despite in-store kiosks and, in some markets, even home delivery, McDonald's is demonstrating that it understands and values its core customer. These customers are the brand's true believers, and it is from them that the business expects to flourish. We remain focused on providing the most positive experience for every customer, every visit, says CEO Steve Eastbrook. We know that our fundamental day-to-day dedication to our customers is running fantastic restaurants, whether it's when they visit a modernized restaurant with welcoming hospitality or the comfort of getting delicious food delivered to their home. Number 6. Dollar Tree. It's difficult not to be enamored with a stock that has quadrupled in value in the last decade. Nonetheless, Dollar Tree, DLTR, has been taking a beating recently. What was their transgression? Their expansion is slower than anticipated. This is typical of businesses like Dollar Tree, which have a business model that caters to budget-conscious shoppers. When the economy is doing well, shoppers choose to do more of their shopping at full-price competitors rather than dividing their trips to search for bargains. Many of these shoppers, though, return to Dollar Tree as the economy begins to slow. After all, as the name suggests, you can get a lot of stuff for $1. Number 5. Procter & Gamble. To see Procter & Gamble, PG, shares as a good way to get through a recession, you have to ignore a lot of the bad news that has been swirling around it recently. For a long time, this large cap stock has been lagging behind the S&P 500. In reality, P&G's stock has risen 12% in the last 10 years, roughly half the market's increase. When it comes to recession-proof stocks, however, you're not blitzing the quarterback. Instead, you're playing defense, and P&G is a defensive stock designed to withstand the test of time. What is the reason for this? Every customer requires brand names on a daily basis. However, they compete in a crowded market that necessitates a business that is dedicated to operating efficiently. And that's just what P&G will give investors. Number 4. Pfizer. Pfizer, PFE, is another example of a stock that can struggle in a strong economy. The only short-term offense, like many others, is that it is not rising as quickly as investors would like. They have some concerns about their latest product pipeline, and their Viagra brand lost exclusivity in December 2017. As a result of all of this, some analysts are advising investors to keep their money in this stock. However, a closer examination of the analyst reports revealed that the stock was rated as a buy by the next largest group of analysts. Do they have any information? Perhaps, but if you're reading this, you're searching for stocks that will do well during a downturn. And there's no question that Pfizer is capable of fulfilling that position admirably. Consumers would need and want your goods. Number 3. General Mills. General Mills, GIS, is a stock that can be purchased in both good and bad times. During recessions, however, demand for their goods continues to rise, owing to consumers' desire for their products as they cut their entertainment budgets. The stock of General Mills does not have the same level of uncertainty as other high-return stocks. For example, in the last 10 years, General Mills stock has had an annualized standard deviation of 17%. General Mills, like many of the companies on this list, is a dividend aristocrat, with a dividend that has been stable or rising for 115 years. This combination of low volatility and uninterrupted dividend payments is more akin to what you'd anticipate from a utility portfolio. This is, however, a business that anticipates double-digit total returns. Number 2. Johnson & Johnson. It's almost too simplistic to point to Johnson & Johnson's, J&J, status as a dividend aristocrat as a justification to keep this stock in your portfolio during a downturn, but it's difficult to overstate. J&J is one of the 19 businesses in the world to have grown its dividend for 50 years in a row. That's a significant amount of time. And there is no sign of it coming to an end. This is due to a well-diversified portfolio in terms of both the goods they offer and the markets in which they are sold. Neutrogena and Listerine are two brands that are practically household names. Pharmaceuticals, medical services, and consumer health are the company's 3 operating divisions that have proved to withstand economic downturns. When many segments are diversified, 1 or 2 units will usually pick up the slack when others underperform. Number 1. Walmart. Walmart, WMT, is one of the businesses that keeps it straightforward, advertising and offering everyday low prices on a daily basis. Analysts may underestimate the retailer in strong economies because its margins are squeezed, but the business consistently shines during recessions. The business profits from its Sam's Club store chain, which caters to bulk buying customers. Consumers seek the appeal of bulk sales to extend their dollars, so these stores prosper. Walmart has been stepping up its e-commerce efforts in response to Amazon's dominance over the last year, and analysts say those efforts are starting to pay off. Walmart would benefit from a strong e-commerce presence if the economy were to fall into recession. In 2008, the company saw a 7.2% rise in sales and a 20% increase in stock price, outperforming the S&P 500 by 58.5%. Despite Wall Street's warnings, Walmart was one of the few companies to raise its dividend yield in 2008. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, Be sure to hit that subscribe button before you go. Thanks for watching.